All right. Are we facing the interest rate apocalypse? Because if you read media reports right now and pay attention to the news, it feels like, not actually, as it feels like we're in for a ton of interest rate increases and things are going to start to spiral to the point of panic. In actual fact, that's probably not going to happen. We don't have a crystal ball, but we're going to get into why interest rates are moving, both variable and fixed, and the actual impact it will have on you and your mortgage, because we're going to do a bit of math at this first. So let's first deal with fixed rate mortgages. In a fixed rate mortgage, your fixed rates are tied to the bond markets. Well, over the last 2 years or so, the government has been pouring millions of dollars into the bond market to support the bond market. That's kept interest rates very low. That's called quantitative easing. They've since started to pull back on the quantitative easing. So we're seeing interest rates for mortgages on the fixed side slightly climb. Now, not crazy, but they're climbing up a little bit, 2.69, 2.79, 2.89. Let's be honest, it's still a mortgage for under 3% interest. In the big scheme of things, that's still pretty cheap money anywhere you look. Variable rate mortgages tied to the Bank of Canada prime lending rate, which currently right now, 0.25%. Which is what the banks set their prime lending rates on, which bank prime right now is about 2.45 for most banks and lending institutions. The variable rate mortgages right now are prime minus 1, prime minus 1.1%, prime minus 0.9%, depending on the lender. So at 2.45% prime rate, you could be seeing mortgages on the variable side, 1.45, 1.55, 1.65. Still great for substantial savings up front if you're in a variable rate mortgage. Or if you're looking to renew and you're considering variable versus fixed, please know that variable rate mortgages do not change month to month. The only time your variable rate payment will change is if the Bank of Canada moves the prime lending rate and your bank moves their prime as well. On top of that, you can also set your payment in a variable rate mortgage so that the payment stays the same, but the amount of interest you pay as the markets fluctuate just changes. But your payment can stay the same. So you can do that too. So what impact does that have? What's the real life dollar amount that looks like for you as a consumer, as a mortgage holder, when it comes to your mortgage? And what does that mean? So we're going to do a quick screen share here. You'll have to forgive me for the high-tech graphic package that I've got here. We've paid extra for this, but we're going to do some simple math and show you what this looks like in real terms. And this is the stuff that you don't read in the media articles. So we're going to take an average mortgage amount, $350,000. The payment on a 1.65% variable rate mortgage right now, $1,424. If the Bank of Canada increases the rate by 0.25%, your payment goes up to $1,466, or a difference of $42 a month on the average mortgage. Now, keep in mind, you had to qualify for that mortgage at 5.25%, which is the stress test rate. To get to this rate from your 1.65, the Bank of Canada would have to increase rates 14 times. Try and fathom the catastrophic impact that would have on the economy. So let's look at the second scenario. $350,000 mortgage, 1.65% variable, your payment's still $1,424. Let's say over the next 14 to 16 months, the Bank of Canada increases the rate 4 times for a full 1 percentage point. So now you're going from 1.65, you're now paying 2.65. Your monthly payment goes to $1,596, or $172 a month increase. You still had to qualify at 5.25%. Yes, that would not be great, or that's $172 you'd rather put in your pocket, but this is the discomfort level to the point where you no longer qualify for your mortgage. There's still a pretty big spread. Let's say you've got a fixed rate mortgage right now at 2.79%. That's an average fixed rate for many A lenders. $350,000 mortgage, your payment is $1,618. If you're in the variable rate situation of 1.65 and we factor in the 4 increases over the next 14 months, your payment's at $1,596. So even after 4 Bank of Canada increases, you're still coming out ahead $22 a month, $1,618 in the fixed, $1,596 in the variable, $22 a month. You're still coming out ahead. So if you're in a variable rate mortgage, please don't push the panic button. Please don't worry about whether or not you should switch over to a fixed rate at that point as well, too, because you can do that in a variable rate mortgage. But long story short, the math and the actual scenario versus what we read in the media is very different. None of us have a crystal ball for this. None of us can guarantee that this is the scenario, but I wanted to explain to you in a little more detail what's happening with regards to interest rates and why. and the impact it has on you as a mortgage holder and a consumer. So if you have questions about your own mortgage, if you've got a renewal coming up, if you're looking to refinance and maybe try and get a better interest rate, please reach out at any time. We're happy to do a free analysis for you and find out if the scenarios work for you and see if we can put you in a better place moving forward, either physically in a new house, emotionally, and financially. Reach out anytime.